get started. Hello, everybody, and good afternoon. Welcome to the panel, Fraud and Security in the Digital Economy. It promises to be an interesting and entertaining, hopefully, and forward-looking panel. We're going to discuss about various types of fraud, new emerging technologies, and opportunities for the entrepreneurs. To get started, let me introduce my expert panel. So joining us today, we have Bernard McManus, who leads the Global Fraud Management Organization at Sony Interactive Entertainment. His previous fraud and security roles, spanning over a decade, include leading product management for fraud and security at Western Union, Deluxe Corporation, RSA, and Athenian Group. Next to him, we have Peter Martin. Peter is the head of payment risk product at Google, responsible for payment risk management on 120 billion annual volume and 50-plus products at Google, including Play, Cloud, and mobile payment products. Before joining Google, Peter was director at seller risk at Groupon and director of risk at PayPal. Next to Peter, we have Amir Sunderji, a seasoned payment executive with over 20 years of experience in risk management, consumer finance, and payments. Prior to his role at Early Warning Services, Amir was the chief risk officer at Yapstone, and before that, chief risk officer at Fiserv for digital payments and at CashEdge. CashEdge was acquired by Fiserv for $465 million. So let's kick off our discussion. Let's begin with discussing, what are the various types of fraud that each of our panelists face. And, I would love to hear from them a specific scenario of, a fraud that they have recently encountered and how they have sort of addressed it. So, we'll start with you, Amir.
Sure. To me, there is only one type of fraud which is illegal or criminal. However, when you look at fraud in its entirety, you find different flavors. And the flavors would range from, let's call it friendly fraud, which is somebody who did a transaction or purchased something and is now repudiating or refusing the charge. That varies from verticals to verticals. In financial institution, it's somewhere in the middle in the hierarchy. In other places, probably at the top. So that's one of the primary types of fraud we see that. The second label I would look at is a new account. So somebody opening a bank account or obtaining a mortgage or enrolling for a payment service and so on, using somebody else's ID. Whether it's ID theft and acquired either through data breaches or many other ways, compromised credentials, etc. And so that's the second one. The third I would look at is account takeover. So there's an existing customer with an account, let's say at a bank, and somehow, again, the credentials are compromised, either through phishing, smishing, or even social engineering through call center. I don't know how many of you know, but in call center, it is estimated that each call results in a 65 cents loss because of fraud. So that's an average. You take all the calls and the number of fraud that perpetrated through call center social engineering. So it's another area where an account could be taken over. And then you have other variety of cards, which is lost, stolen, counterfeit, etc., which is coming down with EMV. And it's not raising its ugly head as it used to be. Then you have elderly abuse, which even feds have noticed in the last few years, where home caretaker, whether it's family, a friend, or a paid caretaker who is managing your finances, taking care of you at home, does your banking, has access to your passwords or bank information or your profile because the medical records may be at home, and that is taken over. And so that's another type of fraud that we see from time to time. We also have, what we also notice, especially in the financial industry, is collusion between two parties. And those are very, very difficult to detect, but everything looks kosher on both sides until you get a return through ACH or a chargeback. And then finally, if you are an aggregator, you would see merchant fraud. Now, that can vary in different degrees and based on the vertical, but it could range from taking money and not supplying goods or services, and can result in different type of fraud activities perpetrated by a merchant. So those are some of the categories I would look at.
Bernard, would you like to add to that?
Yeah, sure. So most of the places I've dealt with fraud are focused on e-commerce, so card not present environments. Exactly what you would expect: account takeovers, stolen financials, touching a little bit on like the elderly abuse, like scams are definitely a thing, not just in-home abuse, but through phone calls and other techniques. There's actually, if you look at like mass quantities of the data, there's about a 33% increase in scam victim likelihood at 65 years old, and then another 37% increase at 70 years old. It's a vulnerable population, which is why the regulators are starting to pay attention more and more to elderly abuse, and it's a big deal. Probably the biggest deal is really account takeovers in the e-commerce space, like in my world. The breaches that happen out there just in the wild, Yahoo spilling 2 billion credentials into the marketplace, and by marketplace I mean the criminal marketplace, is a really bad thing.
Except for job security.
Except for job security, yeah. The bad guys then buy those lists and walk them against different sites. Consumers, 70% of the time, use the same email and password everywhere. They don't use password vaults, they don't use hard passwords, they use one hard password everywhere. And then the account's taken over. And that's really the top of the ATO funnel, is those automated attacks using credentials. Most people view it as an InfoSec problem. But it's really a fraud problem. They're not taking over the accounts to do anything other than fraud. It's just an economic equation to them. And the technology is getting more and more sophisticated that they deploy to do it. Dealing with that problem, since you asked how we're dealing with it, it's really a form of class identification. Back to the earlier panel on machine learning. Like Google actually has a solution to it. It's the idea of trying to tell if something's an automated attack or a normal attack. That whole "I'm not a robot" thing Google rolled out with their new reCAPTCHA is a form of machine learning class identification. It's trying to tell different classes of users. And so that's how we're trying to deal with it, is to push that, not on the web page though, but to push that to the edge of the network.
So Peter, I think we've got a lot of fraud types. Are there any more?
There are, but I think Amir covered the majority of the fraud types out there. Google is in primarily e-commerce space, so most of what we see, similar to Bernard, is account takeover, which is relatively small for us. Payment fraud, stolen financials being monetized on our platform. The biggest and most challenging problem we face, though, is we bucket it as friendly fraud, but there's subcategories of family fraud. So my daughter using my device to buy digital princess dresses had that experience to the tune of about $500. I did not charge it back. I used it as a learning experience and a teachable moment. But there's those components, right, where you want to offer some friction, like a CVN or something to challenge, make sure it's a kid not, abusing basically their parents' access to the account. The big one for us, and it's been a very, very painful problem to solve, is malicious friendly fraud. So the individual is the individual, right? All the data ties out. All the machine learning models you have say, hey, this guy looks good because it is the user. So to predict the moral ability of that individual is very difficult, right? Whether they're going to actually charge it back. And so that's the space we're actually really pushing solutions right now with the card associations. But that's a space that, stolen identity in that is very, very common, I think, for bank accounts, financial services, ATOs, like right now, combined with stolen financials and stolen identity is a huge problem. So in my former life at Wells Fargo, as new account acquisition, and that was it's a pain point, but banks usually use a lot of data. 20 plus data aggregators to make those decisions. Heavy vetting up front.
Let's continue on that thought. Can we dig a little bit deeper on the solutions that either you have seen work or you have employed? Emerging technology, new approaches that you have found to be effective in solving for these types of frauds. So, Peter, can we get started with you?
Sure. One of the luxuries I have working at Google is a lot of computing power. So it's not my computing power. I did nothing to create it, but I leverage it along with my engineering team. So the big ones are just data. I mean, risk is really simple. I explain to folks. Generally bore my children talking about my occupation, but it's basically data and a lot of it, and ideally clean data, and modeling techniques, right? How to identify the goods and the bads and just separate it. So it's not traditional machine, like unstructured machine learning, where you just throw a bunch of data in the hopper and see what comes out. It's feature engineering. You're trying to predict a specific binary outcome, generally, good or bad. And so having access to lots of data and having access to machine learning pipelines and fast processing has made our lives a lot easier in managing traditional payment fraud. In terms of technology, it just comes down to how much capacity to process and how fast can you do it. Can you get a good decision quickly? I think the other one is the ability to connect with other data sources in real time. Gives you a lot of opportunities as well. And ability to interact with your user. So we have a lot of opportunity for user challenges, like did you do this transaction, that sort of thing. So we're seeing a lot of capabilities out in the market. It's just bringing it together in a holistic approach.
Okay. Bernard, would you like to continue on that?
I'm going to agree with Peter actually on the data front. It's not just clean data, it's fast data. But data is key to predicting fraud behavior, both friendly and everything else. To enhance that data, we probably had several dozen different data enrichment pipelines. When he mentioned pulling more data in, not just your data that you have on site, but enriching the data that your modeling system can do. Hard rules don't work, for fraud anymore. They used to work when it was a much more simple environment to a degree, but if there's just a rule we won't let them spend more than this much money, well, the fraudsters will start spending $1 less very fast because they are also using a lot of data in testing and automation to do it. Eventually, we're probably going to be in a state where it's just a computer fighting a computer. Yep. And it's not that far away. DEF CON last year was the AI computer battle, and the third place winner put their source code up on the internet on all their different penetration and other tools that are AI driven. And we're already starting to see some of those techniques being used. Behavioral biometrics is a big thing. So not just identifying the machine because that can be faked to look good, but identifying that it's a human and that these behaviors are the same as other humans. The swoop of a mouse cursor is hard to fake, and it's identifiable actually. It's like a fingerprint. So a biometric behavioral fingerprint, as it were. That data enrichment is really useful for detecting fraud. Going back to that class identification, you can do good users versus bad users, not just robots versus people. So there's a lot of new techniques in that front that are pretty promising.
And some really creepy ones, which I cannot share with you, but only used for good.
We would expect that from Google.
Amir, would you like to add on to that?
So I would pretty much echo what my colleagues talked about. The challenge, there's one more type of fraud that I just thought about because I got a call this morning from a friend of mine, former colleague, and that type of fraud has spiked up almost 50%, and that relates to charitable sites where charities are soliciting donations. And so he called me up and he said, I have a fraud problem. We just lost $100,000 for the weekend. And I said, no, it's a chargeback.
Closer to the mic.
Sorry. So he called me and said, hey, we have a $100,000 chargeback. Can you help me out here? What can we do about it? And I said, no, you got chargebacks, fine, so return the funds. You haven't lost anything in terms of money. But apparently what happens is they get chargeback fees, Then there is processing fees, gateway fees, that amounted to almost $100,000, and this charity with little money was defrauded. So, and that's on the rise. And what is happening, it's called cardable sites. So what you do is you go in there, make a dollar donation, 50 cents, test the card is live and active, and go shop. And it's done within 48 hours. And so that's something those who are in charity business would be very vigilant about is, it's profiling and how much your donors donate to you, periodicity, et cetera. That's goes into data, as we talked about. But that's another rising fraud. In terms of what we are looking at, so there are several things, right? Data. Now, data, call it big data, call it smart data, but it's all about variety, it's all about volume and velocity, and can you process that in memory, in real time, to render a decision? That has been a challenge. Now, for early warning, you have to think about, and you may be able to relate to that, is all those big banks contributing data on their customers. We're talking about millions of accounts, probably 60%, 70% of DDAs in this country, right? And associated transactions. And now when you get a transaction, to be able to ready to process that in real time, to make a decision whether it's a good transaction or a bad transaction, is challenging. And so that's the area we're exploring. Now when you add to that other data sources, alternative data sources, whether it's social media, whether it is devices, whether it's a mobile device, whether it's browser related, bringing all that in and being able to render a decision. Now think about this, right? In the old days, if I went to get a loan, all I did was take my picture, my family, my house, and next is my priest is standing next to me, and hey, he's a good customer. Those days are gone, right? Or I want to find out about Peter, I talk to my neighbor. They're gossiping all the time. I don't go to Yelp or LinkedIn. But what has happened is that over time, the models that were developed were more generic in nature, right? So they took all the goods and bads and say, hey, if the profile looks like this, a good customer. If a profile looks like this, a bad customer. Then we started to make finer gradations. And now it's really coming to, as Bernard said, using biobehavior metrics to pinpoint and identify the user-level interaction and being able to make a decision on that user and not on all the users as homogeneous users. So that's critical, and so that's what we are exploring right now.
Okay, great. So, Alok did a show of hands in the previous session, and there were a fair percentage of the audience who are interested in, doing a startup. So what advice would you give folks who want to do a startup in the fraud management space? So, Bernard, let's start with you this time.
I'm probably the cynic on the panel on this one. There is a lot of startups trying to get into this space. And they all try to sell me stuff. So that might be why I'm a cynic. Even in the behavioral biometric space where I mentioned, there's 5 major players that are duking it out. One just got picked up by one of the schemes. So even in that space, probably from an e-commerce standpoint, there's only 2 or 3% adoption of that technology, even though it really works. Because it's a basic ROI question, just like any other technology or software installation. If the merchants or banks don't have enough fraud to make it worth the very large cost of that operation, and when you're talking heavy-duty processing power and data needs and big VC investments, it's a big price tag for some of these cutting-edge solutions. So if they have $2 million in losses in they want to charge $3 million, that merchant $3 million to have the platform, no merchant's ever going to buy that. They can only go after the biggest high-volume merchants with those solutions. And those merchants are more often to have internal solutions. So it's kind of a catch-22. It's hard to break into this space. And everyone that's already in this space, honestly, they're trying to expand to not be a one-trick pony. They're trying to become platforms. So there's a lot of really big companies that have a bit large customer base that are like, we also do that, in that. And they're buying like the smaller companies. So if it would be, take a look at the space, take a look at the place, try to identify something new that doesn't have 6 other companies doing it, and go after that. And right now, there's 6 companies doing most of the stuff that's been identified. So it's going to be very hard.
Peter, what are your thoughts on that?
Yeah, I concur. I would say it's probably 5 years too late. There's a lot of startups in this space. A lot of my peers, actually, from PayPal and former team members, it signified, so they have good solutions. It comes down to the data, right? They don't have the data the merchant does. And as Bernard mentioned, the large merchants generally invest heavily into their own risk products to scale, and a lot of customization. So all my peers at Amazon, Facebook, Microsoft all have custom internal risk shops. I would say, though, there's plenty of opportunity in the space. Instead of going after like a market for the merchant side, which I think is fairly saturated, what I'm seeing is less the fraud, which we thankfully got mostly under control. It's the declines and the false positives on the issuer side for credit card payments. And most of them use a fairly simple vendor solution, HNC's Falcon product. And again, it's a great product. When I was at Wells Fargo, basically in this industry, if you don't use it, people look at you sideways, right? And banks sometimes aren't known for innovation, it's more security. If folks can go out and build a better credit card model for the banks to make better decisions and reduce the false positives, there's a lot, and I mean billions in revenue, to come from that. So to me, that would be a great spot to innovate in. The other one, and probably the card associations wouldn't like to hear this, but ACH payments is nascent in the US, and ACH risk management is very difficult. Very few companies actually allow like P2P payments to be funded by ACH. So innovating in that space where there's not a lot of players, granted it's really hard, I think would have benefits, especially as ACH is switching to real time in the US, and same day, first step in the US in probably 2 years. So lots of, I think, opportunities in those spaces.
I just want to jump in. Like when Peter says there's a lot of false positives in the credit card side as far as financial institutions, it's like 12 to 1. So 12 good customers per one bad guy caught. E-commerce on average, and we're talking some non-sophisticated shops, is about 8 to 1. So there's a lot of room to improve what the credit card issuers are doing as far as false positives. And connecting merchants with the issuers better and like bridging those gaps would be a great solution to go to.
Absolutely. I mean, if you could even get it, it's probably higher at some issuers, to be honest, because they don't optimize those models, right? And so you have like 30 to 1 in what I heard from some of my peers, and they want better solutions. It's just not a lot of people are building solutions for that market because it's not as sexy, right? It's like big banks, big financial institutions, not the consumer side and what have you. But that's a space where there's innovation, opportunities, in my opinion.
Any opportunities, Amir, that you
Yeah,
can
I
think of?
think as you guys were talking, I was thinking about the transactions that go into review bucket, which is about 29% in some cases. There's a huge opportunity and it's a huge cost. So there is definitely room there. The other area where I haven't seen much, maybe because I haven't taken a look at it, but how do you engage a user to authenticate a transaction after the transaction has been submitted, but pre-authorization? That may be an area to be explored. I don't know how much is out there, but that's what I was thinking about. And at the end of the day, it's really, if you go back to biometrics, it's how do you have a biometric authentication through omni-channel, right? So that is another area which is in its nascent stage. So there probably is room there to explore that. Not only that, coming through that and adding to that contextual factors, whether it's transaction, IP geolocation, device, biobehavior, whatever that may be. And that comes back to integration. Do you have a solution we can integrate all this in a way that is sustainable in cost, it's effective, and it's user-friendly? Because you have to think about adoption. I mean, think about, I was just reading last week or this week about Apple Pay. The usage has come down than when it started. The novelty has worn off. So is this something that is for the long term or not? And how can you have users adopt that? I mean, some of the areas to think about. And I think you have to think through the whole solution, not simply adding some point solution and presenting on a platform.
Okay. Cool. I think we're close to running out of time, but maybe we can take just one question from the audience. Are there any questions? Yes, please.
Let me just restate that because I think your mic might not be working, but what's the percentage of basically false positives, right, for models and hurting customers? So,
Bernard?
Sure. So, like I said, e-commerce in general has about an 8-to-1 false positives. Most of that is driven by the merchants who are using outsourced rules-based systems that are much higher than 8-to-1, and it just inserts friction. It's like, well, we're not going to release this order until we talk to you in a manual review, which is costly, or we're going to make you submit again, or verify certain things. And then there's shops that have like 2-to-1 because they're very model-driven and have very clean and fast data. So there's just a lot of extremes, even in the e-commerce space. In the banking space, like Peter said, there's some banks that are 30-to-1. And that's when you make a credit card purchase and you get a text saying that it was declined, but was this you? Please try again after you click yes. So all of those like clearing, things, making that better and more seamless or getting it right the first time, is the goal. Like you can't really get below 2-to-1 false positive though, unless you have a whole lot of data. So catching one bad guy, you're probably going to insert friction into 2 good customers, even in the best of shops.
I'll add to it. I mean, it's too high across the industry, right? I think we need to do better. The problem is it's hard, even with data. And then it's a P&L decision, really. It's a ROC curve or a gains chart, right? What percentage of bads can I capture with this amount of insult? And it depends on, risk or bottom line losses. So $1 of revenue, or let's say $100 of revenue in some merchants is needed for $1 of bottom line loss. So that ends up being a magnifier in terms of mitigation. So they err on the side of more conservative. I launched a model early in my career at Wells Fargo that was like 99-to-1, and everyone was like super happy with me. When I tried to do that at PayPal, damn near got beaten to death. So that was unacceptable. So yeah, we try to keep it in the 5-to-1 minimum bar. As Bernard said, like the goal is to get it to like in the 3-to-1, but you have to take some losses to get it to that point.
So at the end of the day, I mean, if you think about from the financial perspective, the theoretical point actually is where your marginal revenue is equal to your marginal cost, right? And how do you get there? In financial institutions, they're different because there's money at stake. It's not goods and the lost profitability. So you try to calibrate that and arrive at the conclusion based on what your models are telling you. It's if you add to that. So think about this: if you add declines to reviews and to people who are challenged through challenge questions, right? If you consider that as your false positives, it's a big number. It can go up to 30-40% easily.
Oops, that's my timer going off. So we've pretty much come to the end of the panel. I would like to thank again our panelists for sharing their expert opinions, and we all will be available outside the hall if you have any more questions. Thank you.